Make yourself immune from the danger of market volatility. That's the third big danger that causes most retirees to outlive their money. The first danger is taxes. The second is inflation. But the third is market volatility. And I want you to be recession proof because recessions are going to keep occurring because of irresponsible government spending and the printing of money. We experience these dangers. So in this educational episode, I'm going to address why market volatility is the third big danger that causes most retirees to outlive their money and how to make yourself immune from market volatility. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people prepare for long-term goals such as a comfortable retirement where hopefully they will not outlive their money. Now, I have studied retirees, thousands of them for now 5 decades, and I've found that there's 3 big dangers that cause most retirees in America to outlive their money. Again, the number one danger is taxes. And so I make people immune from that by advising them to convert 40, 60%, or even 100% of their retirement income to be totally tax-free. So it doesn't matter what the taxes go up because they're totally tax-free. And that's in my favorite vehicle, which I call a laser fund. The second danger is inflation. And so I show them how to use a strategy called indexing, which actually helps them link their returns to the things that inflate so they will outpace inflation. I've always earned a rate of return greater than the inflation rate at the time. But the third danger is market volatility. That's what this episode is about. And this is what causes so many people to outlive their money. And why is that? Well, if you look at where most Americans, and I'm talking about 91% of Americans, put their money for retirement, it's in tax-deferred IRAs and 401ks invested in the market. And when they begin to approach retirement, I look at their situation and I go, wow, this is not a good picture here. You were probably told you would be in a lower tax bracket when you retired. Are you in a lower tax bracket? And they go, no, we could see the writing on the wall for years. We're savers. And Congress keeps raising taxes. Okay, well, we got to convert it to tax-free. Inflation is going to double the cost of living every 5, 6, 7 years, it looks like. And so you've got to have your money in something that will earn a rate of return equal to or greater than the inflation rate. But because of market volatility, the third danger, if you haven't realized, Wall Street was not ever designed to create predictable cash flow or income. If you ask Wall Street, when is the best time to sell my mutual fund shares or to sell my stocks, what will they tell you? Never, okay? And so, no, you have to in order to create income. But if you ask a financial advisor who has your money invested in the market to create an illustration showing predictable income, I'll be shocked if they do. But if they do, I'd be very shocked if they showed you more than a 4% payout. Why? Well, they don't want to be sued for you outliving your money. And even though they're telling you, just hang in there, you should average 12% with your money in the market. No, people aren't averaging 12%. Dalbar, who studies investor behavior, says, well, first of all, if you bought and held, and you didn't get affected when the market was going all over the place and topsy-turvy and crashes and everything, you would average 9.14% if you had your money in the market. That's before tax. And but most people are not earning that. But if you average 9%, $1 million nest egg ought to be able to generate $90,000 a year at 9% without depleting your principal. Well, you pull out $90,000, and in a 33% tax bracket, you're going to pay $30,000 of the $90,000 in taxes. You're only netting $60,000 or $5,000 a month to buy gas and groceries, prescriptions, and golf green fees. Now, if $5,000 a month isn't going to cut it, because inflation, the cost of living might double in 5 years at 15% inflation, you will need maybe $10,000 a month to buy the same gallons of gas and loaves of bread, prescriptions, golf green fees, whatever, that $5,000 bought just 5 years ago. And so that causes you to pull out more money. Well, here is this third danger, and that's market volatility, because Dalbar also says most retirees, they don't buy and hold. They panic because they might have $1 million nest egg, and when they see it in the market take a nosedive, down 15%, 20, 25%, most Americans go enough already. They can't stand to see their $1 million retirement nest egg go down to 700 grand and 600 grand, like they saw twice in the Great Recession. 2001 to 2003, the market dropped down about 40%. And then it took 4 years to come back to break even. And then in 2008, it dropped 40% again. And it took 4 years till 2012 just to come back to break even. People who were retired in the year 2000 felt like they had lost their future. Basically, they didn't earn anything for 12 years, but they were nervous. What did they do? When the market went down, they sold. And then they waited until the market came back up and they bought high. And so guess what? The average return for most retirees is on their money, 3.49%, because they're buying and selling at the wrong time. This is what precipitated the 4% rule in the financial services industry. If you're only going to average 3.5% return on your retirement assets and you pull out 4%, you're going to slowly deplete your nest egg, but not before your LE. LE is life expectancy. And so that's called the 4% rule. They only want you to pull out 4%. That means on $1 million nest egg, they only want you to pull out $40,000 a year because they don't want you to sue them for outliving your money. If you want to pull out more than 4%, they'll make you sign a waiver that you won't sue them. That's the 4% rule. To me, that's ridiculous. That's unacceptable. You pull out $40,000 out of $1 million nest egg and you have to pay tax on that $40,000. In a 25% tax bracket, you're paying $10,000 in tax, you're netting 3% or $30,000. If you subtract the 1% asset management fee on that $1 million nest egg, you're only netting 2% or $20,000 to buy gas and groceries. That's pathetic. I would rather pull out $80,000 or $100,000 a year. $80,000 is 400% more than $20,000. What I'm talking about here isn't a little bit better. It's 4 times better or even 5 times better, because many people using my favorite vehicle, the laser fund, they're able to generate 10% payouts on $1 million nest egg, $100,000 a year of tax-free income without depleting principal. Well, how do you do that when the market is topsy-turvy? You use the laser fund because you're using a strategy called indexing. I'm not talking about index mutual funds. This is a strategy where you have, let's say, your $1 million nest egg safely tucked in a multi-trillion-dollar insurance company in indexed universal life, and they are crediting you the general account portfolio rate on their billions and trillions of dollars at shopping malls and skyscrapers and AAA and AA bonds and what have you. And even though when interest rates are low, they might only be earning, let's say, 5%. Anytime you feel like the economy is going into a recession, you can just, settle for the 5% every year. 5% on $1 million would be 50 grand, and it's tax-free. That's better than losing money when the market crashes. But any year that you feel bullish about America, you can tell them to take the interest on your million, 50,000 in this example, and buy upside options in whatever index you want to choose. You can use several or just one, let's say the S&P 500. And so that gives the insurance company the wherewithal to pay you 8%, 12%, up to a cap as the market goes up, because the options double and triple. And so they can pay you whatever the market does if the market goes up. But if the market goes down, you don't lose any part of your million principal. You gave up the interest on your million that year. The options expire worthless. But if you do this historically, you'll have 7 up years in a decade, 3 down years, but you'll come out and you'll be averaging 7, 8, 9%. But if you diversify between different indices and you rebalance, meaning that if you're headed for a recession, you don't sit there and earn 0 for several years. You move back over and earn the 4 or 5% general account portfolio, or you rebalance to different indices. Usually you can tweak your rate of return up to that 10 and even 11% range. And if you're earning 11, you can net 10 over the life of a contract. because only 1 percentage point goes out for the cost of the insurance that the IRS says has to be there in order for it to be tax-free. So long story short, $1 million nest egg can generate $100,000 a year of income, tax-free income, even if you're only earning 8% if you pull it out the smart way. I wish I had more time in this episode, but you can learn more by studying my book, Why This Knocks the Socks Off of Most Places Where Americans Put Their Money. You want to have your serious cash, the money you've earmarked for your retirement, in a vehicle that eliminates the dangers, makes you immune from taxes because it's tax-free. Inflation, it will make you immune because inflation won't hurt you. It will actually help you. You're linking your returns to the things that inflate. But number 3, you're eliminating the danger of market volatility. Because when the stock market goes down, you don't lose. You may not make much of anything, but you don't lose. But as soon as the market turns around and goes up, you start making money again. In 2008, a lot of our clients that had indexed universal life were going, go, go, because they weren't losing anything. And the first 90 days of 2009, many locked in gains of 16% tax-free after not losing a penny. Most Americans had to wait 4 years until 2012 to get back to break even from the money they lost in 2008. By the end of 2012, many of our clients had doubled their money. This is critical for you to learn. So the best way for you to learn is, first of all, study this book. This is my 11th book. I've been very honored in my career to have authored 12 books. They're all bestsellers. This is in its 8th printing, and it's flying off of our warehouse shelves. You can go to Amazon and get it for $20 plus, about $10 shipping and handling, but I'll gift you one free. So this is actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations of how to diversify and create the foundation for a tax-free retirement if you're a left-brain learner. You like numbers. If you learn more by stories and examples and metaphors, you turn it over and read this one, about 100 pages, 12 chapters with 62 actual client stories of how a properly structured IUL contract can be the dream solution not only for retirement, but college funding for your kids and grandkids, working capital for your business, real estate management, emergency funds, maximizing your pension if you're a school teacher, police officer, firefighter, on and on and on. It's the dream solution for many financial goals. And so simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I require a little skin in the game, and I'll cover the rest of that cost, but I'll pay for the book. I will fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, check out the audio and video formats. There's even a lengthy master class if you like to do a deep dive. You can register for a free educational webinar that we do on a regular basis. You can even schedule an appointment to talk to an IUL specialist that I've trained, that I oversee, and with no cost, no obligation, they can meet with you once, twice, several times to show you how this may work in your particular set of circumstances. And there's no cost or obligation if you say thanks, but no thanks. But this is not about me. This is about you and your brighter future. So claim your free copy now. Click on the link below.